Hey, it's Sasha Evdokov, and welcome to TRADERSFLY.com, where I share with you some insight about trading and investing on the stock market. Now, this week, I want to share with you the pros and cons of a market order. Now, if you're looking to trade in the stock market, you need to understand the different order types. So first off, before we get into the pros and cons of a market order, you need to understand what is a market order. And basically you have two different order types. You have a market order and you have a limit order. The limit order allows you to specify what price you want to purchase a certain stock for. So for example, a stock is trading at $30 and then you want to purchase it at $22. The limit order allows you to specify that you want to purchase it at that $22. The market order, on the other hand, says, I want that stock and I'm willing to pay whatever the price is in order to get that stock. So if you've ever been to a fancy restaurant, or at least a specialty restaurant where sometimes things are not as abundant, for example, fish, sometimes you will notice on the menu that it says market price. So you'll pay for, let's say, a grouper sandwich, the market price, or what it currently is. Now, even though you may have paid for that same grouper sandwich last week $20, this week that market price might be much higher. It might be $100. So in theory, if you don't ask what the market price is, you may be paying exuberant prices for that grouper sandwich. Now, this is probably and typically not realistic, but it can happen. So always ask for what the market price is, at least if you're in a restaurant. Now, unfortunately, in the stock market, things are a little bit different. You don't really get to ask, hey, what's the market price? You get to see what the trading price is, or what the current price is, or what orders have been filled at what price recently. But you don't get to ask really, hey, what's the market price? Because there's other data showing you at what price range the orders are going off in. Now, if you have a really liquid market, meaning there's a lot of shares traded, there's a lot of activity, market orders are typically fine because you'll get it in very quickly at whatever the rate is because there's a lot of trades happening at that time. However, if there's not a lot of trades happening, or you're trading a really small stock that doesn't trade a lot of volume, or the market is just maybe more on vacation, it's a holiday, or maybe even a half day from those holiday seasons, then you could get into some real trouble. So really, if now you're placing a market order, you're going to pay whatever the rate is at that time. And there's certain times where a stock may jump in very volatile sessions up $5 or $20 or $50, all within a blink of an eye because there's nobody there to buy or sell shares. And especially if you're trading after hours and you're putting in market orders, this can become really problematic. And it's at that time where you see those stocks spike up really high or dip really low because people are buying and selling at market prices. So what you really don't want to happen is for a stock that's trading $25, you don't want to be the fool that's paying $50 for that stock after hours because you put in a market order and there was only one other guy to sell you the shares. So instead, what you want to do is always focus on putting in limit orders. However, market orders are still really great, especially if a stock is exploding to that upside and you need to get into that stock very quickly, then you want to place a market order. It's because there's activity. It's because you're time sensitive. And if you're time sensitive on your order, you need to get in it right away. It's at that point where market orders are great. Now, unfortunately, you still may end up paying slightly higher prices on a market order because you're looking to get in and you're time sensitive. But if you're in a liquid market, it may only be just a little bit. If you're in an illiquid market or very light trading volume, you may pay exuberant prices. So it's a trade-off. Do you really want to get into that stock very quickly, or are you looking to really look at what price you're paying for that stock? Now, personally, I always recommend that you go ahead and place limit orders, especially if you're new, you're just getting started, and you're unsure of what type of order to place. Always start with a limit order. As you start developing experience and things become a little bit more active for you in trading, then market orders may be a good idea at certain specific times. But again, it's a strategy. It's because you're time sensitive. You really need to get into the stock, or you're just buying a ton of shares that you just don't care what price you're getting into the stock. But in general, focus on limit orders. However, market orders still can be great at those appropriate times if you definitely want to get into the stock and you're very time sensitive. So to summarize, what are the pros and cons of market orders? Well, basically, you can get into the stock at any point as long as you're willing to pay the higher prices for those stocks. Now, unfortunately, because of that, you may also pay exuberant prices or unexpected prices if the market is not as liquid. So again, another downside is if there's an illiquid market, you're going to be paying higher prices. However, you do have a higher chance or higher probability of getting into a stock or a trade or not missing a run to the upside if you place a market order, rather than you may miss the stock or the run to the upside if you're placing a limit order if your limit is not so tight to the market price. In addition, if you're looking to purchase a large lot of shares through a limit order, sometimes it's very difficult. Whereas with a market order, you can definitely get the amount of shares that you're looking for, so long as that you're willing to pay the price. And finally, if you're trading not liquid stocks or not in a liquid market, but you still need to execute the trade, go ahead, place the market order, and then you'll get into the trade. So in the end, if you're looking to get into the stock, the market is not liquid, and you really need to get into it, and you're time sensitive, market orders are great. However, if you care more about the price, if you're really conscious about your risk, then stick to limit orders, which is typically the route I always advise for most people. Thanks for joining me in this video, and if you enjoyed this video and you want to see other great videos and mini lessons that we have available, you can click this link, and when you get there, you can enter your name and email address, and we send other great free goodies and free trainings through the newsletter list. And while you're there, you can also browse the website and take a look at some of the other free trainings that we have available. Now, if you just want to see some of the other videos I have in the channel, then just click one of the thumbnails below and we'll continue learning together. Thanks again for joining. I'm Sasha Evdokov, and remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.